Well, hello everyone. Welcome to Trading a Smaller Account. It is a fresh new week in the markets. The sun is shining here in Salt Lake City. It looks like we may be drawing to a close on this government shutdown, which, I think has everybody feeling a little lighter today, particularly those who have been waiting for some time for a paycheck. So yeah, life is good. We have got a lot we want to cover today. And so we're going to focus on a trading strategy today that I think is cautiously optimistic. Let's put it to you that way. And it's a short put vertical. So if you are not familiar with short put verticals and you're brand new here, just let me know and we'll take 20 seconds and go over what a short put vertical is. We're looking to place 4 new example trades in our account. And then we have 5 trades that have hit targets, 4 that have made us smile, 1 that has us snapping our fingers and going, dang it. And some of them were strategies where we were comparing and contrasting. So 3 stocks, 5 trades to review. So we have got a huge amount to get through in our 45 minutes together. I've got Mike Fairborn with us in the chat. If you have any questions, don't hesitate to ask. He's a friend and a fellow coach and has a ton of experience. If you aren't following Mike and I on Twitter or X, now known as X, please consider this your formal invitation. Mike Fairborn, CS, and Barb Armstrong, CS. And just before we get into the throes of all of our, trading shenanigans today, just a quick reminder that options carry a high level of risk and aren't suitable for all investors. We use the paper money software application on the thinkorswim desktop platform. So if you're using thinkorswim web or trading from your phone, things will look a little different. But, using paper money is just a brilliant way to be able to hone your skills, make sure you understand your strategy, all of that good stuff. Sonia is saying that she is new here and would appreciate a description of this strategy. So thanks for letting me know. I'll make sure I go over that. This is considered to be an intermediate level class. So we do cover a lot of ground. And if you're thinking like, holy smokes, Batman, she sure is moving quickly. We do move quickly in this class, but the beauty of it is that these are archived so that, if you want to go back and review how trades are placed, which when I started, because I'm a client, I started as a client attending webcasts like this. I just marked down, okay, at the 15-minute mark, go back and I could go to the archive, scoot ahead to the 15-minute mark where a trade was being placed, and then just, pause, back it up, repeat if I needed to, when I was new. So, yeah. There's that. One of the differences or nuances with paper money is that short options will never be assigned early. That can happen in a live account. We're going to do a very quick market overview. We're going to place some new example trades, and then we're going to go back and look at those trades that have hit our targets and exits. Okay. Now, I thought I had it in here. For those that are new, this year we started with 25,000 in our paper money account. Our max position size if we're buying stock is 5,000. And you might say, hey, that's 20% of our account value. And while that is true, we did that so we could do stuff like buy right covered calls on stocks in that $50 range or less, that kind of thing. And our max risk per trade were around $500 on that. And our focus is on short to intermediate term timeframes. And we trade, both bullishly and bearishly, depending on, what's going on in the market. Okay. So let's come out and look at the S&P 500. So we, hit a new all-time intraday high back on October 29th. And, it's we've come back to kiss the 30-day moving average, as we have done many times since April. And, it hit that 30-day moving average and is moving back above today. So it looks like this bullish uptrend is still intact after the last week of pullbacks. And, we see that here on the NASDAQ as well. Came back, kissed the 30-day moving average, as it has done many times since April. This is a 6-month chart. Year to date, the NASDAQ up 20%. The S&P 500 up a little less, but still up 15, which is pretty decent. How about our Dow? The Dow is a little different than the other indices in that it's based on the price of the stock as opposed to the market cap of the company. But, you know, it looks similar, doesn't it? And this is up 10. So we're at 10, 10.8, 10, 15, and 20%. These indexes are up. And how about our Russell, which is 2,000 of the smallest of the 3,000 companies that are part of the Russell. And, you know, this index up 10% as well. And it came back and actually, you know, moved through that 30-day moving average, and we'll see, you know, if that it can break back above that and continue to use it as support, or if in fact this is going to act as a ceiling or a resistance level. Now, when we look at our volatility index, we saw a lot of volatility. You know, in the last couple of weeks in the markets. But if we look at this 6-month chart, it's back under that 20 level. We're sitting around the 18 level today, which shows that things are kind of calming down after, you know, these spikes that we saw last week. Okay. Okay. So there we go. So let's start with a couple of new trades, and it depends on what your routines are. Like, my routine is to kind of look at what I have. And part of the reason for that is that I want to make sure I'm not placing multiple trades on the same stock. But I know that for those that are new here, you may say, hey, like, let's get to the new stuff. So we're going to start with a couple of new trades, and then we'll go back and we'll look at some of the trades that we have already put on. Now, if you are new, and so let's go to trade number 1. So we're going to come to Microsoft. Little company in the tech space. And it's been kind of going sideways, hasn't it? Since it hit this high back here at the end of July. But, you know, can we trade something going sideways? And if you are new to this short put vertical strategy, I'll show you where you can access an example trading plan. I'm just waiting for my, but I say that this is something, if you're cautiously optimistic, this is an interesting strategy. Oh, let me just move this here to another screen. Because what we're doing is we're selling a put. Now, this is a $500 stock, and you may say, well, if I sell a put, I'm agreeing to buy the stock. And we certainly don't even have 50,000 in our account. We have 34,000. So we're going to both sell a put, and then in order to define our risk, below that, we are going to buy a put. And we call this a short put vertical. Now, why would we do this? Well, we might consider this strategy if our belief is that the stock is likely to stay above the strike that we sell. So in this case, if we come out and we look at selling the 490, what we're saying to ourselves is, hey, we think that this stock is going to stay above 490. And if it does that for the next 20 to 50 days, then we have a successful trade. Okay, but if we're wrong and something goes amiss, and even the best technical analysts and traders are wrong some of the time, if it goes through both our strikes, then our max loss, let's say we get paid $1.50 to place the trade, how much are we risking? If our strikes are $5 wide, we're risking $5 minus the $1.50. So our max risk is $3.50. So we've defined our risk, because when we buy a put, it gives us the right to sell the stock. So this is called a bull put spread. It's called a short put vertical. And then some people call it a credit spread. So if you're new to trading options, like, that is super confusing. And I didn't come up with all these different names, like, don't shoot the messenger. But yes, bull put spread, I tend to refer to it as a short put vertical. So I will write on my chart SPV for short put vertical, but it's modestly bullish in that if it just continues to go sideways, we're happy campers. If it goes up, happy campers. If it, you know, it can even come down a little bit because it's at trading at 500, if our strike is at 490, we have $10. So we can even be a little bit wrong, if you will. Okay. So there's a strategy in a not in a nutshell. Okay. So let's come out here and see if the juice is worth the squeeze. So if we come out here and we say, okay, we wanted to look at this 490 now. If we come out to say December 5th, this is a very heavily traded stock. So, and if you want to create an example trading plan, I have a framework under the trade management mini session section, and I'll show you where to access it. And I'll put in a link in the archived webcast to this as well. But, you know, does this trade more than 8 million shares a day? Check. If we come and look at this 490 strike, are there at least 20 times the number of contracts we want to trade? Well, we're probably going to do one contract. So, and there's almost 3,000. So yes. Is the bid-ask spread tight? I.e., is it less than 10%? So is it less than 60 cents? It's 10 cents. So check, check, check. So now can we make enough money on this for it to be worth their while? Well, if we get paid $1.50 and we say, okay, we're going to come to our calculator and say, okay, if I can make $1.50, and this is the most I can make is $150, what am I risking? Well, I'm risking $5 minus the $1.50. So I'm going to divide that. So what's 150 divided by 350 is 42. And our rule of thumb, just so we can do an apples to apples comparison, is, you know, is it, if we're in it for 25 days, are we getting at least, you know, 25%? And we're getting 42. So check box number 4. All right. Now, some might say like, hey, isn't it better to look at the monthly options? Like, you know, don't they trade more volume typically? And so if we look at the 490, yeah, there's, you know, 5,000 contracts instead of, you know, 3, you know, but if I'm in it for 2 weeks more, so 39 days instead of 25, how much more money would I get? And so if we come out to December 19th, you get another 15 cents. And so some might think, well, I'd rather do 2 trades than only get 15 cents to be in it 14 days longer. Plus, if I'm out further, time decay is going to, you know, work at a slower rate. And so I think I'm going to stick with December 5th for that reason. Okay. So single order, first trigger sequence. And then in our example trading plan, we have said to ourselves, we'd like to exit this when we've got 80% of our max gain. Now, some might say, I want to let it expire worthless. Some might want a 10%. Get out when, you know, they've got 90% of their max gain. We're saying, hey, we got 80%, we're good. Yeah. So time decay. And one of the nice things about December 5th is we've got Thanksgiving, where, you know, even on Saturdays and Sundays when the market's closed, time decay is working. It's also working, you know, on that Thursday, on Thanksgiving Thursday. It's working on the Friday afternoon when the market's closed. So we're getting some time decay when the market is closed that's working in our favor as well. Now, how much are we risking here? 350. So should we do 2 contracts? Well, no, we don't want to risk more than $500 to $550 on a trade. So no, we're doing 1. And why is that? Because our max risk per trade is 500, and that's a rule that we don't break. So somebody said, you know, Sharon is saying, hey, how about doing a long call vertical? We could. And, you know, we've done a lot of, you know, kind of comparing and contrasting of that. So we could add a long call vertical and then compare them, but it's more directional, because if we did a long call vertical with the 500 and the 505, then it has to go up through the 505. So if we wanted to do that and compare them, and if we want to make it, you know, this one, we could come out here to December and give it a little more time. And this is a $1,500 option. So on a long call vertical, we have our max gain if it goes through both strikes and stays above that. And with this one, we're looking for a 50% gain. And we could make almost 100. If you look at this, we're risking 253 to make 247. So at 250, you're risking one to make one. But when I first started trading these, I would hang out for that 100% gain and, almost never got it and thought, well, maybe I'm being greedy. Maybe we should just say, hey, how about a 50% return? That's a pretty decent return in a short period of time. And so we'd make this 375. And with this one, we could do 2. But this strategy is more directional. So here's our long call vertical, and we're going to compare that to the short put vertical. Okay. Fire in the hole. Excuse me. Oh, glad I hit the mute button because my sneezes are not delicate. Sorry about that, guys. Okay, so that's Microsoft. Okay, let's come and look at Tesla. So Tesla. And when we come to the chart on Tesla, we can see this is a stock that's up kind of modestly less than the major indices. But, it's kind of had a bit of an up and down year, but it seems to be uptrending here. We're on the other side of earnings. And, it's kissed this moving average or this diagonal support line and appears to be moving up. Now, this is a stock that has more volatility. So if we come to the trade tab, we can see our volatility on this is at 60%. So what does that do for us? Well, if we're right, and if we come down here to say the 425, maybe, we get more premium. And where's it trading now? 448. So, that's 20 some dollars, $23 worth of wiggle room. But, this is a stock that can move $20 in a day. So I'm sorry, where did I say again? We're going to come to 425. So at 425, again, does it trade more than 1 million shares a day? Check. At 425, do we have a tight bid-ask spread? Check. Do we have more than 20 contracts? Check. So if we look at selling a vertical here, we get $1.75. So if we say, well, that's got to be close to 50%. If I can make $1.75 and I'm risking $5 minus that, so $3.25, that's a potential return of 53%. And so we're in it for 25 days. First trigger sequence, right click anywhere on these two lines, create an opposite order. We're going to say when this is worth about 34 cents, or 80%, buy it back. And again, how many of these are we doing? 1. Why? Because we're risking 325. Yeah. So this is going in our short put vertical bucket. And again, what is the beautiful thing about this trade? And if you want to see it on your chart, and I'm actually going to record a little video on just a review on how to do this and post it on X this afternoon. Just if you want to see something on your chart, I can put this 425, that's where our strike is, and then come up here and say short put vertical 425, 420, December 5th. And then when I come to my chart, I can very easily see, where my strike is and what I want to have happen. Somebody's asking what kind of car I drive. Yeah, I drive a Mercedes, but yeah, that's neither here nor there. Okay, so we've got filled orders now. So these are the orders that hit our targets today. So let's come and look at, we did those 2 trades on Microsoft. Here's the one to open. It's now saying they want 4 cents more. So we can just come in and cancel and replace that order and say, okay, we'll give you 250, no problem. And that's for our long call vertical. And we're going to compare it to the short put vertical. And I'll make sure that these fill. So the market, things are moving around a lot. Our working orders, and if you put them by time placed, and then here's our Tesla at ones. So, we just need to give this a couple of minutes to percolate. And the same with Microsoft, because it's saying the amount we want to be paid is what the current mark is. It just hasn't quite filled yet. Okay, so that's Microsoft and Tesla. Okay, let's do one more. Apple. Apple. An apple a day keeps the doctor away. So, we've had this stock uptrending since when? Like since the beginning of August, in this, kind of range. And it's been kind of going sideways here. So you could call this a bull flag. Some would call this a bull flag and a stiff wind, because it came out and then the flag is coming kind of straight out. But if we say, well, it's, come to this diagonal support line, what if we sold a put, did a short put vertical below that? So around this 265 level, could we get enough premium for it to be interesting? So if we came here to our trade tab, again, coming out 25 days, and we wanted to look at the 265, so below that support level, we've got a 10-cent bid-ask spread, lots of volume, trades more than 1 million shares a day. And if we look at selling our vertical, $1.50, well, we now know 150 divided by 350 is 40-some%, 42.8. So that meets our criteria. Single order, we're going to make it a first trigger sequence, right click, opposite order, 30 cents. And we now know we're only placing one trade because we don't want to risk more than $500. And that's not a rule that we break. So if you want to hear a funny story, my son, when he was in pre-4, told me he was in love with both a little girl and a little boy in his class, and he wanted to marry them both. And when I said he had lots of time, but he had to pick one, he said, "Is that a rule or a guideline?" It's like, how do kids come up with this stuff? He was too young to have seen Ghostbusters. So, there's our trade number 3. Now let's come and look at a couple of the trades that we placed last week. So ISRG is one that we placed last Monday. Okay. So, and we did both a short put vertical and a long call vertical. Okay. And so our short put vertical was here at 525 and 520, and the long call vertical 535, 540. And if we come to our monitor tab, the account statement, and type in ISRG, now everything's filling. So here was our call vertical. So let's look at that first. And we'll do that in blue. So we got into this call vertical for 250, out for 435. And so how much did we make? So this is our long call vertical. So we made 435 is what we sold it for. We paid $250 to get in. Now, why did we do only one if we paid $250? Well, we put in the order at $290, which is why this target was $435, and it filled at $250. So we got a better fill than we were anticipating. So we made $185, and we just did one contract. So it was $185 base hit. And for our return on risk on that, to calculate that, we would say, okay, that is, how much could we have lost? 250. So we made 185 and we were risking 250. And so our return on risk on that was 74%. Now that is higher than we're usually aiming for. But the reason for that is we thought when we put the order in at 290, then the stock must have dropped a bit because, or it could have just been a paper money fill. But, you know, happy camper, we added $185 less our transaction fees, which were $1.30 to get in and $1.30 to exit. Okay. If you did that with Schwab. Now the short put vertical, you know, this is different in that, you know, we were paid $1.60 to get in. And these are the ones we just did 3 example trades on. So we received $1.60. Today it hit our target and we bought it back for 27. And again, we put both of these trades on last Monday and they both hit our targets today. So on this one, we came out $1.33 ahead. Now, what were we risking on this one? Oh, no. Dang it. Okay, let me just come here and do it another way. So here, our return on risk was, we made $1.33 and we were risking what? Well, we were risking $5 minus 160. So we were risking 340. And so that came out to 39%. And again, you know, happy camper status on that. You know, base hit. So somehow my drawing tool doesn't want to play nice. So I can't do the happy face. So, you know, those worked out nicely. Okay. So paper money fills, sometimes they can be close to a live account, and sometimes you get kind of what you call a paper money fill, and you know, it's just more advantageous. So another trade that we did on Friday was on Toast, and it was a bearish trade. And Toast, well, we got toasted on Toast. So, and I think when we put this on, it was a bearish candle and then it rallied at the end of the day, as many stocks did. But this was our 1 ATR target. And then here was our 1 ATR exit. And it came and hit that. Like when I first looked at it, this was like a very long tail doji, but it hit our exit. And so what did that wound look like? Well, let's come and look at it. So Toast. So this is a pretty easy one to calculate. So bring up my drawing tool one more time, see if it's going to behave. Sorry, let me clean the slate. So here we ended up down by how much? Because we paid $1.77 to get in, and then we got out when it hit our exit for $1.09. So on this one, we were down by 68. And how much could we have lost? We could have lost $1.77. So what was our return on our risk here? Well, we lost 68 out of the 177 that we could have lost. And so we were down here 38%. So that was a loss. And we were down times 2 because we did 2 contracts. This is when we're grateful that we position sized appropriately and didn't break our rules. So we were down $136. Now, I was going to show you how to adjust a stop today, but you know, when we look at this, I would consider this a successful trade. Now, you know, I just went over how we lost money. But like Chris said, a 38% loss isn't too bad, because how much could we have lost? We could have lost all of it. So I say that it was a successful trade in that we placed a trade using a trading plan. We followed our rules and it didn't work out. Where I think it's an unsuccessful trade is if you place the trade and then you don't follow the guidelines or the rules that you have set up. Yeah. So, you know, let's do just a quick foray over to the Trader Talks channel. And this is, if you have not subscribed to the Trader Talks channel, you're just, you know, you can just go at any time that you like, but you may as well subscribe. You know, it's free to do that. It helps us out as it'll show our stuff more in the algorithms on YouTube. But what first comes up is whatever's currently being taught. And then if you come to playlists, I just wanted to create a space where we could put all this additional resource I wanted to create for you guys. And so what I'm currently working on is a bunch of very short videos on candlestick patterns. So they're like video snacks, like they're all kind of 3 to 5 minutes, 2 to 5 minutes long. But these are a little longer. And so here's an example trading plan for short put verticals. And then here's one for long call verticals. These are the 2 types of trades. And then we did a long put with a 1 ATR target. This is the long call version of it. You know, so you can watch these and then from that create your own trading plan. Okay, use it as a framework, you know, and they all will include, you know, what to buy, when to buy, how much to buy, and when to exit, both if the trade goes for you and against you. And the last part is, what's your weekly routine or what's your daily routine? And with these short verticals, the routine is, and let me show you just how arduous this can be. Dang it. Doesn't want to come back up for me. There we go. So let's come to our current activities and positions. Here's how we review our short put verticals. Are any of these close to 80% up? Are they up 50% or more? Nope. Are any of them down dramatically? Nope. We don't have, well, we did have one negative on Tesla, but you know, everything's up. So we're good to go. How about on our long call verticals? Is anything up close to 50% or down close to 50%? And INTC this morning was actually up, you know, and it was, you know, so we're getting close. So that's the only one that we might want to take a look at. INTC. So, oh, INTC, try it again. Here we are. We want it to be in the next 2 weeks back above here. It's bouncing off the support level. And like many stocks in the market, up, and this dark green means it's still above Friday's close. So I'm not quite sure why it's showing a negative. We had time decay over the weekend, I guess. But, you know, we'll look at this one again on Friday. Okay, so there's INTC because you asked me to review that. Okay, now the next one that hit a target was JP Morgan. So JP Morgan, back on October 27th, so it was a couple of weeks ago, we saw this diagonal resistance breakout and we did a long call vertical, And that hit our target that Friday, October 31st. And then the next one, we also bought some shares of stock, and this is an expensive stock, so we didn't buy very many, but we bought $5,000 worth, and that hit our target today. And I don't, like, our target was 317.52, which was the previous high. I'm surprised that I put the 2 in there. It's usually a round number, but regardless, it hit our target today. So if we come to our monitor tab, and I promise to compare and contrast these. So if we look at it, okay, so we bought the stock. So that was the first one. So here's our stock. And we bought the stock for 303 back on the 27th. And this morning that hit our target. And we got out at 317.80, which was probably the opening price. So if we look at our 317.80 and we subtract our 303.51, we get 14.29. And with this, there is no transaction fee because it's a stock. And then we had 16 shares. Was it 16? Yeah. So we ended up with 228.64. You know, we would call that a base hit. You know, so we're pretty happy with that. On the long call vertical, you know, we paid 285 to get in. Our target was probably this 425. So how did we do on that one? Well, that was 425, and we had 2 contracts here, minus the 285 we spent to get in. So we were risking about 570 on this one in total, because we could have lost all of that amount. And so we ended up by $1.40 a share, you know, times 200 shares. So we were up by 280. You know, so we were up by a little bit more, and we did it in less than half the time. So you may say, well, obviously the long call vertical is the way to go. But, you know, if the stock hadn't moved through those strikes and stayed there, we could have lost this whole amount. Where if the stock went sideways, we may not have made anything, but we wouldn't have lost anything either. You know, and we had until November 21st on this. So this had a time limit on it where the stock really doesn't. So these are things that we have to take into account as well. And here, our return on our risk, I didn't calculate that, but we made $14.29 on a price of 303.51. So if I take $14.95 divided by 303.51, that was about our return on our risk here was about 4.7, or our return, as many people would say it, you know, return on our investment. You know, where here, our return on our risk, we were risking 285 a contract, we made $1.40. So that came out to 49%. But, you know, you don't, it's not an apples to apples in that this one worked out well. Our percentage loss, had it gone against us, could have been more like 49%, and our loss on this could have been closer to 3 or 4%. Yeah. Okay. So that's that. So those are the 5 trades I wanted to review, and we've now reviewed them, and we've showed you also just how super fast you can go and review your short put verticals and long call vertical positions. Okay, I did say I wanted to place 4 new trades, so here's the last one. We're going to go look at a little Amazon. Anybody ordered from Amazon recently, or is it just me? Yeah, it sure is handy, isn't it? So if we look at this, could we come down to the 240? And you might say, well, it's at 247. It seems to be, quite a bit higher. Well, let's see if we can get enough premium. If we come out again to that December 5th, does it trade more than 1 million shares a day? Yep. How about number of contracts? Good. Bid-ask spread, 10 cents. We're cooking with gas. Sell our vertical, $1.40. And again, by now we kind of know 140 divided by 360. Oops. 140 divided by 360. 38%. Are we good? We're good. Is that more than 25 days or 25%? It is. So repetition, the mother of all learning, right? Right click, first trigger sequence, create opposite order, 28 cents. Good till canceled. So actually we put 5 trades in today on 4 different stocks. So 4 of them were short put verticals. And one of the questions or comments I often get in the surveys is, would you please review the trades we've done? So we put in trades today on, let's see, they haven't all filled yet, but we have put in trades on Apple, on Microsoft, on Tesla, and on Amazon. And on Microsoft, we did both a short put vertical and a long call vertical, and I'll make sure that those fill after the class. So I hope you have found this helpful and informative. We also reviewed the positions we exited on JP Morgan, and we compared and contrasted a stock position and a long call vertical. We compared 2 trades on ISRG, the short put and the long call vertical that we placed last Monday. And then the trade gone wrong on Toast that went up and hit our exit, a 1 ATR bearish trade where we bought a put. So hit the like button. It helps move things up in the trading algorithms, in the algorithms on YouTube, so that more people can find us. As I like to say, you could be doing a favor for a random stranger whom you may never meet. So it's your chance for your Good Samaritan moment. Subscribe to the channel, Trader Talks channel, if you haven't done that already. Follow Mike and I in the land of X, Mike Fairborn CS and Barb Armstrong CS. I want to thank Mike for his help in the chat. You guys asked a lot of really great questions. And yeah, I want to thank you for being here. Up next, Mr. James Boyd. You won't want to miss him, so stay tuned. And thanks to the guys behind the scenes for helping out as well. I'll see you all tomorrow in Getting Started with Technical Analysis. Bye for now.